Hello and welcome to Fixed Income Markets, our bi-weekly analysis on fixed income markets with fixed income experts Francesco Castelli, Head of Fixed Income Banor Capital. Francesco, lovely to have you again.
Thank you, Marcello. Thank you for having me.
Sure. So, Francesco, we've seen quite a lot of news flows in the last few days on interest rate expectation, interest rates cut, ECB. Why don't you take us through all these news flows on the different geographies?
Yes, of course. Yeah, it's been a busy couple of weeks. The ECB, as you can see in the chart, decided to cut rates for the first time during the Lagarde era. On the other side, as you can see from expectation, there's very little for the rest of the year. Lagarde was very cautious. Inflation remains high. So she said that we are not we haven't got in mind a series of cuts. We will proceed the meeting by meeting. So a lot of cautions. And the same caution is also in the rest of the world with the Federal Reserve and Bank of England that are not ready to cut that much. Probably one cut for the rest of the year, not too much. In fact, if you see the Fed projections that has been released very recently, you see that at the beginning of the year, the Federal Reserve used to promise, quotes, 3 cuts. These dots are the chart where the Federal Reserve represents their own expectations for their rates. It's not a promise. It is a way of in their transparency. And in March, they were saying, listen, guys, probably we will cut 3 times this year. On Wednesday, they said, oh, no, unfortunately, we're going to cut only once. And this is going to be probably after the summer, probably in November or December. The good news, however, is they keep on talking about cuts and they keep on promising cuts for the future. For the 2025, now they have 4 cuts expected. And they keep on thinking that 2 years down the road, they will bring rates to 3%. Which is, in the end, not very good news for the short term, but a decent news for the medium term. In fact, if you look at long-term rates, these have stabilized. They are still relatively high, but especially in the US, you can see that they are stabilizing, coming down a bit. We think that for bond investors, this is going to be supportive because central banks, again, they are not talking about raising rates. The interest rate hawkish phase, the tightening phase is now over. And so it's supportive for bond investments. Moving to...
They all, just to put some little certainty, they are excluding to raise rates. They have decreased the number of cuts, but at least we got some update on direction and at the moment on number of cuts, which are limited to 1, possibly, yeah?
Exactly. 1, possibly 2, but yeah, the expectation for this year now is very limited in terms of policy expectations. In terms of spreads, this has been a very good period. As you can see, spreads peaked in November 2023, and the peak coincided with the moment in which investors started to realize that rate hikes were over, so that the phase of stability. They've compressed a lot of spreads, both in high yield and investment grade space. We don't see any further room for compression, also because these spreads are really, really low. The other big problem with spreads, and if you can move to the next chart, is that the safer part of the investment universe is already very, very tight. You can see that the double B is the spread for the safer or stronger high yield issuers, and as you can see, the spread is already below 200, which is quite tight from an historical perspective. If you want to take risks in high yield, unfortunately, you have to move to a much riskier bucket, which is the single B, which of course is wider in terms of spread, but is also riskier. And we think that prudence in this phase is very important. So that's a conundrum for us investors. Do I move to something which is safer but too tight, or do I prefer to take too many risks? In our view, in this moment, you have to be very, very, very careful. Also because, as this chart shows, the perception of political risk is on the rise. And this is going to be a big contributor to volatility in Europe. The bond market has been particularly sensitive to political news in France. And we are coming back to the days where investors start questioning the stability of the whole European system, not just of France. As you can see, this reaction has been really, really nervous, and this is just a few days where with spreads moving up very, very fast to the same level since in 2016 and 17. Is this too much? Yeah, probably there's a degree of excessive reaction. Yes, of course. The other side, the debt to GDP of France is now north of 100% and is above Spain. So yes, of course, French ratings remain in the AA region, but the situation is deteriorating, and this is what the investors don't like at the moment.
Perfect. No, as you said, this chart, we were used to the Italian debt, to the Greece debt, to the Southern European debt, and now seeing France, it gives me a little bit of a strange feeling in a way, but clearly, as you said, risk is perceived as there. So interesting comment. I remind you that we are very grateful to Banor Capital, Francesco Castelli, that gives a bi-weekly roundup on fixed income and credit market. I remind you that we have internship opportunities at Mercury Partners Academy. You can follow with guests like Francesco and other guests on our social media. And as always, this program is mainly educational, although it's done with institutional investors who make a living by investing money, real money, by clients. But this is mainly educational, so we do not offer here an investment recommendation. I thank you again, Francesco Castelli and Banor Capital, and for their precious contribution, and we'll see you soon. Thank you, Francesco.
Thank you, Marcello. See you.